Good afternoon, Srikanth sir.
Good afternoon.
Sir, can we start now? Sir, can I start? Srikanth sir?
Yeah, I can hear you.
Yes, sir. Sir, can I go ahead?
Yes, please. Yeah.
Good afternoon, everyone. Myself, Dr. Sri Jani, Assistant Professor, Sri Vidyaniketan Institute of Management, Tirupati. Welcome you all to the National Level Workshop. It is an honor to extend a warm welcome on 5th day of National Level 5-day workshop on deciding behavioral finance and commodity derivatives on behalf of the Sri Vidyaniketan Institute of Management. Warm welcome to our beloved director and convener, Professor Pinarayan Reddy garu. I welcome Mr. Srikanth Kaundinya, Assistant Vice President, NCX, Mumbai, to preside over the workshop. Sir, we had a great session from the last 2 days, and thank you for your enlightening speech. We are really enlightened with your knowledge as well as the presence. And we look forward for your valuable insights into the commodity derivatives to the today's session. Now I request Mr. Srikanth Kaundinya to take over the session. Sir, the platform all yours.
Thank you very much. I'll start by sharing my presentation, and I'll also, because of this bandwidth issues, I'll remove my image, my face from the screen. Okay, just give me a minute. Right. Right. I think you should be able to see the screen now, and I hope you can hear me as well.
Yes, sir.
Right. Okay. So we had, this is the third day, like you rightly said. On the first day, we had a session on introduction to derivatives and to commodity markets in India and abroad. We then went on yesterday on the merits of hedging, and we talked about how risk management is done. And of course, I would like to again reiterate here that once you understand how the concept of hedging, then it doesn't matter in which asset class you are. You can even do exactly the same kind of hedging with using currencies, or you can do it in the debt market for interest rates. As long as an instrument is available, you have the same logic and the same principles and techniques apply for hedging purposes. So once you have, I hope I have been very clear in explaining that whole concept of hedging using the contracts on cotton that I used yesterday. The underlying in the example that I used yesterday was cotton. But the underlying could have been any commodity, or it could have been any asset class. It could have been a currency pair, and so on. Now, today's session is on, see, what is happening in the back end. So when you're trading, what really happens? So what happens to the money, the way the movement of money, the way the delivery takes place? That's all part of clearing and settlement. Now, just want to tell you one more thing about clearing and settlement is that a couple of years ago, that means prior to 2018, clearing and settlement was a department within the exchange. But subsequently, clearing and settlement has now become a separate company. Yeah, it is a subsidiary company. So it's called MCX CCL, MCX Clearing Corporation Limited. It's a separate subsidiary company, and that is true with all exchanges. So every exchange has got a clearing and settlement company. So basically what they have done is they have this entire operation of clearing and settlement of trades and settlement of all trades that is now being done by a separate company which is independent of the exchange. So there have been a demarcation between the exchange operations and clearing and settlement operations. Although everybody sits in the same building, but they have a separate board and they have a separate, separate set of employees. So they have, everything is separate. It's a separate company. So the clearing and settlement, really, what exactly is it? So it is every time you put a trade, what really happens? Okay. So there is something called cash settled and settled by delivery. So these are two kinds of things which happen to clearing and settlement. So whenever you trade, your positions can be cash settled or they can be settled by delivery if you happen to stay with until the end of the contract. However, when you're talking about clearing and settlement, there are two kinds of settlements which are taking place. One is called a daily settlement and one is called a final settlement. So in a daily settlement, you have something called margins and mark to market, and there is a final settlement which can end up in delivery, or it can also be a cash settle. Yeah. So if you look at the settlement part, it can be cash settled or settled by delivery. And there are two aspects of that. One is a daily settlement and one is a final settlement. So now if I go back to this particular slide that in the introduction, the clearing and settlement, the CNS, it is a independent, separate subsidiary company which does this operation. It is basically an interface between the exchange and its members. That means if I am trading or my clients are trading, then they become one end of the spectrum, and the other end of the spectrum is the exchange, right? In the middle, you have the clearing and settlement, which is adjusting for all these trades. So this process, this transaction of members for the trades is executed, and it provides what we call a logical conclusion for all the trades executed. So you remember, when I'm trading, I just need a laptop or a mobile. So I'm just punching something that I want to buy or sell. Something is happening at the end, yeah, at the back end. All this is happening at the back end, but it does involve money. Now, there's the clearing and settlement also takes care of collateral management. Now, what is collateral management here? See, if I want to trade, to what extent can I trade? Can I trade for 10 lakhs? Can I trade for 10 crores? Can I trade for 100 crores? So it will all depend on the collateral management, right? So basically, I need to bring in some money, to show some money, based on which some the clearing corporation will set limits as to how much I can trade. And that is part of collateral management. So I have to show some collateral that I have, and based on that, the exchange or the clearing corporation will set limits as to how much I can trade. Okay, so the collateral management to supplement exposure to margin requirements, that is again part of clearing and settlement. We also call this clearing and settlement as the billing center of the exchange. Okay, so the billing center of the exchange is all the final accounting, everything is done. All the receipts and the invoices, everything is sent by the clearing and settlement. So you have a clearing and settlement, there's collateral management and settlement. Yeah, so these are the two. So I've already spoken to you about the settlement, and now I'm in collateral. I will probably tell you again because I have one more slide coming up there. So the settlement, what we call, like I said, there are two types of settlement in the previous slide. There's a daily settlement and a final settlement. So I'm first going to talk about the daily settlement. So what do you mean by daily settlement is that on an exchange, when I buy a contract, okay, every single day, if there is a change in the profit element, that means if I buy something for 10 rupees and tomorrow the price has become 20 rupees and my profit element is 10, then that 10 rupees will come into my account as mark to market. Okay, so every single day in which my position is still standing, meaning I have not squared up my position, every day when the price changes, every day when the price changes, that means yesterday's price and today's price, the difference in the price, if I have made a profit, then the profit will come into my account. If I made a loss, the money will be taken away from me. So this is called a daily mark-to-market settlement that is taking place on every single day. Alex, we'll show this again later. So the clearing corporation computes the mark-to-market profit or loss for the day for all the members. Now, I just want to tell you that, for instance, yesterday, we probably did something like 24,000 crores of business. Okay, so the total value of transactions yesterday, yeah, I'm not even talking about day before or the last week or the last month. Yesterday, we did 24,000 crores of business. And for every trade that has taken place, yeah, every change in money value that has taken place, a mark-to-market profit or loss is completed and the money is moved. If you've made a profit, it comes into your account. If you've made a loss, the money is taken away from you every single day. So the reason I talked about 24,000 crores is because I wanted you to understand the size of the volumes that have to be settled every single day by way of mark to market. So the clearing corporation, it sends debit credit instructions to the member's settlement account with the clearing bank for the pay-in and payout to take place. So the minute the amounts are computed as the loss I've made or the profit I've made based on the previous day's price and today's price, then that instruction is sent to the clearing bank, and the bank, then there is something called a pay-in or a payout. Pay-in would be if I made a loss, I pay into the exchange, or the payout is I'll get the money. The money comes into my account if I made a profit. Compare this with the OTC market, which I talked about the other day. In the OTC market, if I had entered into a forward contract, everyday movement of prices will not have any impact. The final impact will come only on the settlement day, the final day when the contract is supposed to be settled. But on an exchange traded contracts, this pay-in payout is taking place every single day. And then in addition to this, there's a margin adjustment. So for example, if I'm buying in a physical market, I have to pay 100% of the money to buy the contract, to buy the commodity, the physical commodity. But if I'm buying on a commodity exchange, I don't need to pay the full amount of money. I only pay a small amount of money, which is approximately, it depends on the commodity. It varies from commodity to commodity. It could be anywhere from 2% to 5% to 8%, 10%, whatever it might be. But it will be a very, very small percentage of the total value. Because do remember that I'm buying something in the future. It's a derivative. I'm buying in the future, or I'm selling in the future. And the exchange, what the exchange does is it just blocks a small amount of money. It could be 3% or 5% or 10% or whatever. It blocks that much amount of money because they want to make sure that I'm committed towards the contract, number one. And number two, that amount of money is approximately equal to the one-day price fluctuation that could perhaps happen between yesterday and today. So taking into consideration based on historical price volatility. So on one single day, if the price can shift, let's say 5%, then the exchange will charge you a margin of 5%. So the 5% will be blocked in your account. Here, I just want to say one more thing. Margin monies are blocked and unblocked. And if you square up your positions or if your contracts get settled, this margin money is returned to you. So margin money is always lying in your account. It is blocked and unblocked. It is something like, if those of you who have been trading in the stock market, it's almost like your ASBA account, whereby your money is blocked and unblocked in your settlement account. And the minute you square up your position, the amount of money is unblocked. If you square up your position or if you settle the contract at the end, the amount of money is unblocked. But however, every single day, the margin money is getting readjusted. And we look at this with numbers in a couple of slides to come. So now we are talking about the final settlement. Yeah, the final settlement, one was a daily settlement and the other one is a final settlement. So final settlement implies a settlement at the expiry of the contract. So when the contract comes to an end, two things could happen. Yeah, it's based on something called delivery logic. There are certain contracts where there is no delivery taking place. Yeah, the delivery logic would be in those circumstances, we would say that it is a cash settled contract whereby there's no delivery given or taken. For example, in crude oil contracts, also in crude palm oil contract, and also we have one more contract, a natural gas contract. There are no physical deliveries taking place. So those contracts get settled at cash. Yeah, so the cash settled contract. And this, whether it is a cash settled or it can be settled via delivery, that whole concept is called delivery logic. And that delivery logic is part of a contract specification. So when you buy or sell a contract, in the contract, it will let you know right at the outset, before you even trade, whether the commodity contract that you're buying or you're selling, whether it is a deliverable contract or not. It will tell you very, very clearly. And you should be very well aware of that. So all the valid intentions for deliveries are marked for delivery. Now, there's something about the banking part. Yeah, I also mentioned something like an ASBA account. Yeah, so just remember that. So members, all members. Now, who are the members of an exchange? It could be all the broking firms. Yeah, it could be all the bank subsidiaries who trade, who have got clients who trade on the commodity exchange. The members must have a bank account in designated clearing bank. So the exchange will identify a bank where you're expected to open an account. Yeah. And the exchange will actually appoint the banks and inform the members that here's a list of banks. Please go and open an account at that location. Now, the clearing accounts or settlement accounts, and there's also something called client account. Yeah. So there's a clearing account and there's a client account. Now, what the exchange does is that we don't mix this up. Yeah, the clearing account remains and the client account remains separate. Okay, because after all, you are a client of a member. So the member has got a clearing account. So a member can issue checks from such an account to the client. So there's a movement of money between these two. The only exchange has powers to withdraw money from this particular account, and the client account is really connected to the broking firm. So this is the kind of a pay-in that is happening. So you have clearing account. Of course, there is a little gap here, but actually it's the same bank here. So you at the clearing bank, there is a MCX. The clearing bank there's a settlement account, and also the member or a broker will also have a bank account there, and he too has a settlement account. Now you can see the settlement account of the member is separate from the account of the client. So when you trade, money moves from the client into the settlement account of the member, and from the member, it goes into the settlement account of MCX. So there are very, very clear demarcations here. Okay, and the MCX, or rather I should put it as MCX CCL, they have control over both these settlement accounts. So they can send instructions to block money in this account or unblock money in this account. So if there is any margin to be paid, the instructions will go and margin money will come into this account. If you have made any losses, the losses will come again and it'll be paid into the MCX account. So that is we call it a pay in. But on the other side, if you have made a profit, then money goes into your account. You'll have to give me a minute. Just please, just bear with me. Yeah. So if there's a movement which is taking place if you're made a profit, then from the settlement account, the money comes into your settlement account. And if there is any money to be transferred, then you can transfer money from your settlement account to the client account. So if I am a client trading through a broking firm, if there's any money to be given, the money will be given to the broking firm. And if any money has to be taken, if I made any profit, then the money comes back into my account via this particular route. So these two lines is black line and red line that you can see. One is a mark-to-market payout where profit has been made, and one is a margin refund. So the point of the matter is both these transactions are taking place every single day, like I explained to you in the earlier slide. Now, the banks will obviously act on instructions. The instructions are given by the clearing corporation. So they act only on instructions. So instructions will be block the account or put some money into their account and so on. Now, instructions of the exchange, the instructions are given by the exchange or the clearing corporation to the bank, and those instructions, debit or credit to a member, are irrevocable. They're confirmed and they're binding. So you can't dispute with the bank. If you have any issues, you don't talk to the bank. Bank is only acting on the instructions which are given. So if you have any issues, you have to talk to the clearing corporation. The exchange has powers to act. The exchange has powers to ask the bank to sweep the members' accounts, or in case of a shortfall, or freeze the account in case of a default. So you can imagine it's like a joint account where the clearing corporation is like a big brother who is actually having control on that account of yours. But of course, you have a regulator over and above the clearing corporation. In case of any dispute, there is always somebody there to ensure that you are not in any way, you are not in any way disadvantaged because of any decision taken. So this collateral, which I mentioned to you earlier, so the collaterals that I can give based on which the limits are set for me to trade. So they can be based on cash, bank guarantee, fixed deposits. I can pledge of warehouse receipts and pledge of securities. Okay. Now here, it may look very simple and straightforward, but believe me, when you have lakhs and lakhs of people trading on a commodity exchange, Someone has to keep track of this. And of course, exchanges are very IT savvy, and hence everything is done almost electronically. So here there are two aspects of it. First of all, let me say cash. If you have cash, then there's no problems. Whatever cash you have brought in, a very sizable percentage of that will form the basis of the, the, the limits which are set. Bank guarantee. Now, this bank, you may have a bank guarantee, but this bank guarantees sometimes have got a timeline. Sometimes I could go and go to the bank and I can take away the bank guarantee. In which case, the exchange needs to be informed about it, and hence exchange has to be very well aware on a day-to-day basis as to what the status of a bank guarantee is. Similarly with fixed deposit receipts. So I may have fixed deposit receipts, but what happens if I just go and break a receipt? So hence every single day there is a lot of emails, etc. It's a very well set out system put in place, whereby if there's any change in any of these, the status of any of these, then the clearing corporation is informed. Pledge to the warehouse receipt. Now, if you know that I may be trading in a particular commodity, I have the physical commodity, I have deposited the physical commodity at the warehouse, and against that physical goods which I have deposited at the warehouse, I have got a receipt. I've got a warehouse receipt. Now I can use that warehouse receipt and I can borrow money against that warehouse receipt. So I can pledge of the warehouse receipt. So really, what I'm saying is that here are my goods. They're worth, say, 20 lakhs. And that receipt is there from the warehouse saying that here are the goods lying at the warehouse. That receipt, I can give it to the bank. The bank will give a haircut. There will be a haircut, and they will give me a part of that will be added to my collateral so that my limits for trading can be increased. The last one here is a pledge of securities. Now here is a list of securities which are acceptable. They're generally A group's securities from the A group, and whatever the pre-identified securities are there, part of that given a haircut. By haircut, I mean that if I have got a value of my securities are 100 crores, then there might be a, say, 40% haircut, so that only 60% would be of that value would be allowed for extending credit to me for trading purposes. But remember one thing, there's this securities, the values of securities keep changing, right? Because the share prices keep moving. And hence this, again, the valuation of your securities has to be done on a day-to-day basis. Now, the daily settlement mark-to-market, yeah, it implies settlement of mark-to-market profit and loss, like I mentioned. It's computation of margins as well. So now there's something called a closing price, the daily settlement price. Yeah, there's a daily settlement price system generated at the end of the day. It is basically the weighted average price of all the trades executed in the last 30 minutes in a given contract. So for example, if I buy a contract today, tomorrow, what is the price of my position tomorrow? What is the price of the commodity? So the point here is that the people have traded at different prices. So what the exchange does is, or the clearing corporation, what it does, it takes the weighted average price of all the trades which have happened in the last 30 minutes of a given contract, and that becomes the price for valuation of your position. That becomes a very important price based on which margins are reset. That becomes a very important price on which mark-to-market profit or mark-to-market loss are adjusted in your accounts. So this is done every day. This is called a daily settlement price, or DSP. So for example, now let's do a calculation like I promised you. So suppose I buy one contract. That one contract is actually a 1-ton contract, and I buy it at 51.75. Yeah, so I go to my laptop or my mobile and I look at the contract which is available, and the size of the contract is 1 ton. So basically what we are saying is that we do have contracts where when you're buying one contract, it is that contract size is a ton contract. For example, if you buy a copper contract, if you buy one contract, you would be actually buying 2.5 metric tons. If you're buying one contract in cotton, you will be buying 25 bales. Yeah. If you're buying one contract, then we got our major contract in gold. If I'm buying one contract, then you are actually buying 1 kg if you're of gold. If you're buying the large contract of silver, one single contract, the minute I buy, I'm buying 30 kilograms of silver. So the point of the matter is that every contract has got a size that you need to be sure that what you're buying. So for example, in this example, the size of the contract is 1 ton. So the minute I buy one contract, it means 1 ton. 1 ton means 1000 kg, and I'm buying it at 51.75 per kg. In fact, on the trading terminal, it will only show you 51.75. It is for you to understand that you're really buying 1 ton. So if you're buying that contract, 1 ton, how much is it going to cost you by way of margin? 51.75 multiplied by 1000 multiplied by 3%. So assuming here, I'm assuming the margin is 3%. So that when you do this calculation, it is coming to 1552.5. So this amount of money gets blocked in your account. Yeah. Now let's see what happens on day 2. On day 2, the prices rise. So the price has gone up to 51.95. So I do the calculation again. So 51.95 multiplied by 1 ton, 1000 kg, multiplied by 3.6. Now this margin money doesn't change every single day, but for academic reasons, I've just changed it slightly. From the previous day's 3, I've increased it to 3.6 here. So when I do this calculation again, I get 1870.2. How much money was blocked on the previous day? On day 1, it was 1552, which was blocked. Now it has becomes 1570, which means 317.70 is further margin blocked. So the end of the second day, the exchange will have in your settlement account amount blocked 1870.2. So that will be the amount of margin money blocked. And the second kind of transaction started taking place. The previous day, I bought the contract at 51.75. The prices have risen to 51.95. The difference between the two multiplied by 1 ton is giving me 200. So this is my profit. So this is called mark to market profit. This amount of money will come into my account the next morning. Let's see what happens on day 3. So on day 3, the prices fall. The prices fall to 51.25. So we do the calculation all over again. So 51.25 multiplied by 1000 is 1 ton, multiplied by whatever the margin rate is. So it's coming to 1742.5. So you look at the previous day's price. Previous day, how much money was blocked? 1870, and now the new value is 1742, and hence this margin money released. Yeah, it's released. 127.7 is released in my account. So basically, what is basically trying to tell you that whatever the value of the position is, margin money on that value is blocked in your account. And as the value changes, the value can change for 2 reasons. Value can change if the price changes. The value can also change if I had perhaps purchased a second contract or a third contract or a fourth contract. But in this case, I'm just kept the contract stagnant here at 1 ton. But the point is that every time this price changes, the margins get adjusted every single day. Now, that is the first type of transaction. The second one is mark to market. So on mark to market, I had the previous day's price was 51.95. Now the price has fallen to 51.25. Please remember that we are always using the price of the previous day, not the first starting price. We are using the price of the previous day. So the previous day price was 51.95. Now it is 51.25. So I made a loss. How much loss? I multiply by 1000 and I'm getting 700 loss. So 700 loss, and hence there's a pay in. Yeah. So if you recall the pay in, just to give you again, to just remind you again, I think I had oh my. Yeah. So this is an example of a. Oops. Yep. So this is an example of a pay in. So if I make a loss, there is a pay in. Yeah, there's a pay in taking place. If there's a profit, there is a pay out. There's a payout that is happening. So that is the point I was basically trying to tell you. So we are on day 3. So on day 3, there's margin released and also there's a pay in because I made a loss based on the previous day's price. So now remember one thing, on a commodity derivative exchange, it is you can always look at it from the point of view of what you study in economics, perfect competition. You have free entry, free exit, which means during the life of a contract, during the trading hours, from 9 o'clock to 11:55 p.m. during the trading hours, during the life of a contract, I can anytime square up my position. Anytime I can buy a new contract. So here on day 4, I decided to square up my position. If I wanted, I could have allow this position to run for the next 1 year if it had been a 1 year contract, or if it's a 3-month contract, I would have allowed this contract to run. But if I'm an investor and I'm just trying to make a little bit of money, on day 4, I decide to square up my position. So at the time when I square up my position, the price is 52. So I do 52 rupees per kilogram minus 51, which is the previous day. I go back again. That's the previous day's price multiplied by 1,000. So I'm getting 750. So there's 750 payout, the profit I've made based on the previous day's price. And because I've squared up my position, this entire margin money, which has been calculated here, 1742.50. Yeah, that is what is remaining of the previous day's margin. That entire margin money is released into my account. Okay. Now, the point I want to emphasize on here is that, first of all, these prices, 51, 25, 52, what are these? Where are they coming from? These prices are, of course, the 52 is because I might have traded during the middle of a day, but the price on the previous days where the adjustments were made, 51.25, or on this day 2, 51.95, these are the closing prices of the day. So the closing price is weighted average price of all trades in the last half an hour of trading. Now, if I were to summarize what I've just told you, on day 1, now let's look at this particular one first. Let me just hide that one. Let's look at this M2N. On the first day, I made a profit of 200. On the second day, there's a pay in because I made a loss of 700. Is pay into the exchange. On day 3, when I squared up my position, I made a profit of 750. Net, I made a profit of 250. Now, if this had been an OTC contract, and of course, OTC contracts cannot be for 3 days, they're for 3 months perhaps, but the adjustment would not be made every day in an OTC contract. Okay, OTC contract would be something like this. Day 1, I enter the market. Day 4, I exit the market. The difference between the price at which I've entered and exited, that is my profit or a loss, multiplied by 1,000. It's coming to the same. So you can see whether I do on an exchange platform or if I do it in an OTC market, then the result would be the same. Only difference is that in an OTC market, I'm stuck with the contract for the duration of the contract. Whereas on an exchange traded platform, I have the flexibility to square up my position and leave the market at will during the trading hours. However, every single day, the clearing corporation is adjusting the margins and adjusting the mark-to-market pay-in and payout for each and every position that is taken by a trader. So, and this is all done very seamlessly because of the dependence on IT. Now, this margin money, like I was not stressing on it too much earlier. So like this particular thing, 3.4%, or whether it's 3.6%, whatever this margin money is, that margin money, there are different types of margin monies. One is called an initial margin. Then you have special margins, additional margins, and tender period margins. Yeah. Now, all these margins are based on a lot of risk management that is taking place at the exchange. Sometimes what you find is that the prices keep going up. The prices can keep going up because they're very speculative in their nature, and they might be very inflationary. So the prices just start going up for no rhyme or reason. And hence, if you have identified that because of speculative activity, the margins are going up, what the exchange does is that for every buyer of a contract, they start increasing the margins in percentage terms. So instead of 3.6% margin, they might make it 10% margin, 15% margin, 25% margin, and so on. So if prices start going up, if you are a buyer of a contract, the margins might still get escalating or upwards. But as far as if you're a seller of a contract, then the margins will remain at the same low level. The reason for this is the exchange uses the margin money as a tool for managing risk. So if you find that the price is going up for no reason, then to discourage speculative activity, only for the buyers, we start charging the higher margin rate. Yeah? And it goes in the reverse order. If there's a lot of short selling being done, people are selling their contracts for no reason, people are shorting it and trying to force the market down. In such situations, the exchange will charge you higher margins if you are a seller of a contract, but if you're a buyer of a contract, in that circumstance, the margin will remain the same. So special margins are imposed to control prices from running away, either on the upside or on the downside. But they are only done on one side at a time, and they are called special margins. Additional margins that we have, these additional margins are when you have a very volatile price movement. If the prices are very volatile, then additional margins are imposed. So instead of 3% margin, we can have 10% margin, 20% margin. But because it is volatile, these margins are imposed for the buyers of the contract and also for the sellers of the contract. There's something else. The third one is a tender period margin. Tender period margin comes in at the delivery, because remember, initially when you buy a contract or sell a contract, only a small amount of token amount of money of one day price movement, approximately 5%, 7% or whatever, is blocked in your settlement account. Now, if you are now approaching the expiry of the contract, then it means that you are now in a position to settle the contract by giving delivery or by taking delivery. And hence, at that point in time, the exchange will start increasing the margin money, and it can go as high as 25%, because now the contract is coming to an end in a couple of days. And hence, the exchange now wants to make sure that you are ready with the money to buy the contract, buy the physical commodity at expiry. And as far as the seller is concerned, the seller has to showcase that he has the commodity with him. He can either go and park it at the exchange accredited warehouse. He can go and park his goods there, and he can show a warehouse receipt to the exchange, in which case he need not bring the margin. We call it early pay in. But at this moment, I just want you to understand that all these transactions, the daily settlement margin adjustments, they are all done by the clearing corporation. They are all part of the clearing, clearing and settlement function of a commodity exchange. There's something else, the final day, when the contract comes to an end on the final day, the final day price is based on, you remember when I told you on the first day that when a derivative contract expires, the day of expiry of a derivative contract, which means if I've purchased a contract, say a February 22 contract, February 2022 contract, if I purchase today, and the minute I arrive on that specific day in February 22, the price at which the commodity contract will be settled will be settled at the spot price of that day. Yeah. So whatever the spot price is on the day of settlement, the contract will be settled on that price. How do I arrive at that thing? So we just basically take spot prices are 3 days, simple average of spot prices of 3 days prior to the expiry of the contract. Yep. So whatever the spot prices are on the day the contract expires and 2 days prior to that, we just take a simple average of it, and that becomes the price at which the contract is settled. That is the price at which money and physical goods will exchange hands. Yeah. Okay. And by the way, how do you arrive at the spot price? I said 3 days prior to, we take spot price of 3 days. How do you arrive at that? So there's something called a polling method that is used, to arrive at that. So just to give you a very quick, just to make sure that you understand what I'm saying. So you can have a market where you have a spot price. There's a spot price on any single day. You have a spot price on any day. If I draw a perpendicular line here, this is the spot price and this is the futures price. So the spot and the futures price, there can be a difference. However, the day when the contract comes to an end, on that day, the spot and futures will converge because there is no more futures. The futures come to an end here. So the futures price will be settled at the spot price of that day. So if you have a situation, if you have a contract where the futures price is higher on any given day to the spot price of that day, then that is called a contango market. If you have a situation where on any single day, the spot price is higher than the futures price, then that is called a backwardation market. Yeah. So, but whatever, doesn't matter what kind of a market it is, the day when the contract expires, the spot and the future will converge. Okay. And that conversion is what we are basically talking about. I'm going back again. This is what we are saying. So final settlement price implies settlement at the expiry of the contract. So it is basically the simple average of 3 days of spot prices. So we are basically taking the last 3 days of the spot prices, and we take a simple average of that, and that becomes the price at which the future contract is settled. So now we come to delivery. Yeah. So when you talk about clearing and settlement, the final settlement of a contract can be about delivery. So when you have a delivery on a contract, yeah, that means the delivery logic says that this contract is. So you can see here a little sample of a contract here. You can see where my arrow is. It says delivery logic. It says compulsory delivery here. Yeah, it says compulsory delivery. So which means that on the day when the contract expires, if you have got an open position, then you will be forced to take or give delivery depending on whether you have a buy position or a sell position on that day. Also, this you can look at that, the delivery period margin, which was maybe could have been 3%, 4%, but on the day of delivery, the margin collected is approximately 25% of the value of your position. So delivery, there are three things involved here. One is in delivery, one is support agencies, and there is something called delivery default. Yeah, so if there's a delivery default, there's a penalty. So let's look at that. So delivery is part of contract specification. So you can go to the exchange website of any exchange. There are 86 exchanges in the world. You can go to the website of any exchange and look at the contract specification, look at the delivery logic. If it is a compulsory delivery contract, then you can read that what it says. Now here's an example from my exchange about some extracts from the contract specification. There's a delivery lot. So we are always talking in a particular size, like I mentioned earlier. So our copper contracts are 2.5 metric tons. So there's a lot size. Yeah. So you should be very well aware of the delivery lot size is. There's a delivery center. You should know where exactly the delivery center is. You should also, as a thumb rule, so the delivery period margin is 25%. I showed that to you in a contract specification also. There are two other issues here. One is quality specification. Because when you're buying sitting on a laptop or mobile, and on the mobile and laptop, you're able to see a contract specification, which very clearly tells you as to which quality is going to be delivered. And hence, the quality specification gives you the grades as permitted by the exchange. There are contracts like you have a contract for potato contract, for example. So there might be 46 varieties of potatoes. Yeah. The point of the matter is that you should know exactly what you're buying. And at the end, when you're taking delivery, if I'm giving delivery, I should make sure that I'm giving the quality as promised in the contract. If I'm getting it, if I'm a buyer, then I should be given the quality as specified in the contract. And there can be a discount and adjustment, assuming that there is a differential in the quality, then they can be adjusted. The final price can be adjusted for premiums and discounts if there's any problems with the quality. And there's a delivery order which comes into play. So these are delivery support agencies. So if you are trading in vault or warehouses, yeah. So if you have if it is a bullion segment, like if you have gold and silver, then you are basically utilizing a vault. And if you are using any of the base metals like zinc, lead, aluminium, copper, nickel, yeah, or if you're using any of the agriculture commodities, you're trading in agriculture commodities, then you would be using warehouses, right? There are also something called tank terminals for oil seed, for example. Yeah, so if you are trading in oil seed, then seed oil, that is, you have mustard oil or soya oil and so on, crude palm oil, then there's a tank terminals are involved. So these are support agencies. And then at these agencies, you have quality certificate agencies are there at the location of the warehouse. Their job is to check for quality. And if they are happy with the quality and if it matches the quality promised on the contract specification, then they will be giving you a certificate saying that here is the quality that you have brought and deposited at the warehouse. And you can now, based on that, the warehouse man will issue a warehouse receipt, and you can give that receipt to the clearing corporation by way of your if you're a seller of a commodity, you can give that receipt and say, here is the commodity, physical commodity, which I've promised to deliver. It's lying at your warehouse. And here is the piece of paper stating that it is there. And that is in electronic form, by the way. It's no more a piece of paper. And these quality certification agencies, when they give you the quality certificate, if you want, at the time when you're taking the delivery, and if you're not happy with the quality, you can call in independent surveyors to recheck the quality to match with the quality promised by the exchange. Now, here the issue here is that there's a huge network of support agencies which are normally associated with warehouses. Their job is to provide services for at the time of delivery. Yeah, so they are there at the warehouses. We call them the support agencies. Now, what normally happens is that, first of all, now there's something called we call it a funds pain, right? The contract is coming to an end. You have brought in 25% of the money, and that money is now lying in your clearing account, as in your settlement account. So the first thing is that because you're a buyer, you need to bring in the money. So you have to show that, yes, I have the money, and here is the money. I'm transferring it to that account, to the settlement account. Similarly, the seller of a commodity, what he does is he is asked to go to a designated warehouse, and he has to do something called a delivery pay-in. He's actually giving the physical delivery at the warehouse. Yeah, and after having delivered it at the warehouse, he gets an electronic receipt. Now that receipt, he has to give it to the clearing corporation. So what has the clearing corporation got? The clearing corporation has got the money, and the clearing corporation has got a piece of paper in electronic form stating that the commodity is already there at the warehouse. The next is there's a delivery payout. So the payout is given to the purchaser, to the buyer. So the buyer now is in possession of the goods. The goods, remember, they're still lying at the warehouse. The buyer can now go and re-look at the quality of the goods which he has got. So he re-looks at the quality of the goods. If he wants, he's not happy, he can call in the independent surveyor to see whether the quality is as promised. Because what happens is, like, if in some of the agriculture commodities, there is a mountain of a commodity, right? And when you're looking for you do sampling. So you just take a sample and you do a test on a sample, and based on the outcome of that testing which has been done on a sample, you are basically giving a clean chit, or you're saying that the commodity is not up to mark based on that sample. But suppose you have been given a commodity which has got a clean chit, and now I, as a buyer, I've been given is a delivery payout. I go and look at it, and I find that I'm not very convinced. So I can ask the warehouse man to do a independent check of the quality. They can do a second sampling, yeah, if required. So they've got all kinds of services which are provided at the warehouse, where you can do sampling. If you're still unhappy with that sampling, you can still do a third one. But whatever they do it as per the guidelines of the Indian Statistical Institute for sampling purposes. They follow their guidelines to do so. Once the buyer has checked out the goods and it is up to his satisfaction, then he takes possession of the goods. Yeah, and only after he takes possession of the goods, only then the final payout is made. So the payout is made. Remember, the pay-in was made here, and the payout is made to the member who has sold the commodity. Yeah. So this is actually a flow chart. Basically, what it is telling you is that first comes the pay-in of money. Second comes the delivery, physical pay-in of delivery. So delivery is paid. Third one is that delivery is handed over to the buyer, who checks for the quality, and once he gives his okay to the exchange clearing house, only then the instructions are sent to the member to the clearing bank to clear the money and pay the money to the member. So this is the kind of a system that is put in place. So the summary of the delivery process: there's an intention of delivery by the buyer and the sellers. So when you're trading and when you're coming to the end of the contract, you need to give your intention whether you are really interested in giving delivery or not. You have to inform in the last few days prior to the expiry of the contract. You can inform the exchange that yes, I am interested in giving delivery. Yes, I am interested in giving delivery. Yeah. So then there is finally a dissemination of intent. So this intention, everybody comes to know to the members. Okay. And there's a matching of intentions between the buyers and sellers. Now, remember, when you're trading on a commodity exchange, the trading is basically anonymous. It's all anonymous trading. So this matching of intentions is taking place between the buyers and sellers. It is done in a very open and a transparent manner. Only after the matching is made, only then the buyer comes to know. It's only after the matching, only after that the buyer comes to know that who the seller is, and the seller comes to know who the buyer is. But until that day, nobody comes to know. So this allocation of and buyer intimates the schedule for taking delivery in advance. The copies are exchanged and delivery is completed only after the buyer lifts the commodity and confirms receipt. Now, there's a couple of things here that sometimes the buyer, although he has taken delivery, he may not have taken the commodity out of the warehouse. Yeah. So I have taken physical delivery of the commodity, but the commodity is still lying in the warehouse. In such a circumstance, any costs such as rent, warehouse rent, etc., will have to be borne by the buyer once he has taken delivery. So even though he has taken delivery on paper, but he has not taken it out of the warehouse, and hence any costs associated with the commodity lying at the warehouse, those costs will have to be borne by the buyer. Yeah. Other issues which normally happen because of delivery. Now, this is happening outside the exchange. The buyer is unable to lift the commodity, like I just now said. He has to bear the cost. Seller is unable to deliver. Yeah. Now, this is a serious matter. He's unable to deliver, in which case the exchange might have to buy from the open market and give delivery as promised, because we cannot afford the buyer to in any way feel disadvantaged just because the seller has not delivered. So, and in such a case, whenever the seller delivers, there are mechanisms in place to take care of him. There might be some penalties involved in such a circumstance. There can be a weightment concern where the buyer says that, can you reweigh the commodity? So the seller has already deposited his goods at the warehouse, but there are certain commodities where they lose weight depending on the weather. For example, cotton, if it's too hot, then the moisture might lose, moisture, and the weight, there might be a concern with weightments. Similarly, if there is a lot of rains and rainy season going on, then there's a lot of humidity or water vapor in the air. There are certain commodities which absorb it. This is a problem with certain commodities like cotton and also with oil seed, which have a tendency to absorb uh, water vapor from the air. And what it does is it creates some weightment issues at the time of delivery. The other issues are insurance and transportation after delivery. Not really an issue. After delivery, the problem becomes of that of the buyer. Then this is what I was telling you about. If there's a problem with the quality, there's a second sampling which is done. It is based on the Bureau of Indian Statistical Procedure. So there is a very clear procedure laid out in case of a dispute. So exchange makes the payment to the seller on receipt of delivery confirmation only. So this last point is only when the final thing is there. The other thing is the receipt that we talked about. So if I go and give my goods at a warehouse, I get an electronic receipt. Now, what does that electronic receipt really mean? So it captures a lot of information. So it captures information like the description of the goods, what exactly it is, the quality and the grade of the quality. And obviously, it must match with the contract specification. And then you have the market value at the time of deposit. It'll probably have private markings as well, because in case of a dispute, the warehouse man should know who has deposited those goods at the warehouse. So there should not be a fight between two different depositors at the warehouse. And hence the warehouse man will put some markings on the goods which he has received. So in case of a dispute, we know exactly who has who has deposited it. So the electronic warehouse receipt captures these markings. It captures the name of the insurance company. It tells you whether the warehouse receipt is a negotiable or non-negotiable. Negotiable means that after I have taken possession of the goods and I have a warehouse receipt which is negotiable, and even now, if I think that I don't want to take delivery, I can actually sell that receipt to somebody else who is desperate to take delivery of that physical commodity. So there's a trade which is going on in negotiable warehouse receipts as well. So there's again the receipt will capture the date and signature of the warehouse man, the authorized agent. It will tell you what the shelf life of that commodity is, and the receipt will be valid till the expiry of the declared shelf life. Yeah. After that, you will need to redo. You'll have to survey the commodity all over again, and maybe see whether that the life of the commodity has deteriorated or not, or you can just, in which case they will extend the shelf life. So this electronic warehouse receipt, we've got something called ComRisk. So ComRisk is a commodity receipt information system. Don't worry about that. It's just basically just concentrate on the ComRisk. And we also have CCIL is another information system, that is CDSL, commodity repository system, which is there. So these are the two electronic receipts which are acceptable at warehouses. So with that, I end my session. So I'll open it up now for question answers. So if there are any questions, we can take it. I think we are well in time. I've still got 15 minutes before we go in for the final, the ceremony that you have planned. So at this moment, I would ask you to ask any questions that you might have.
Sir, good evening, sir.
Good evening.
I'm Dr. Dhananjay from Narayana MBA department, sir.
Good evening.
Yes, sir. I just have some small observation, not a question, sir.
Yes, sir.
I often wonder whether these exchanges are creating value for investors or wealth for themselves, because exchanges are at a huge valuations they're trading, or some sort of it's become very big businesses like MCX, NSC.
Yeah.
I want to hear your comments on exchanges themselves becoming a huge businesses or monopolies.
So there are 5 exchanges in India. There are 5 exchanges, commodity exchanges. Okay. So there is MCX, there's a BSE, NSE. Okay. There is NCDEX, and there is a ICE exchange. There are 5 exchanges. So there's competition amongst all the exchanges. Okay. Now, it is basically survival of the fittest. Who can manage the exchange better? Okay. So I know what you mean by monopoly. MCX has got, at the moment, we have almost about 95% of the market share. Okay. So all the derivative trades which are happening, 95% of the total market is in the hands of MCX. Now, the regulator is common to all the exchanges. Okay. So the regulator is very much aware, and the regulator is all the time trying to help the other exchanges as well. It's not just that we have any special status here. It's just that we are better organized and we are doing well. Okay. The same thing with NSE and BSE in the stock market. So you must have seen that NSE came out with some products much earlier than the BSE, especially in the FNO segment. They were the first ones to launch FNO segment, the futures and options segment for stock markets, and hence they have a big hold on that. Yeah. So if you compare NSE with BSE, it's basically how well you are managing it and how well you can now. So NSE had a little bit of a problem a while ago, a year ago or 2 years ago. However, BSE was not able to capitalize on that. I mean, that was a lovely time for them to come in. Now, when NSE and BSE were given a license to launch commodity contracts, by the way, MCX has got the same license. We can move into equity segments if we wish, okay? Because we are all now under SEBI, and just like BSE and NSE can move into stock markets, we too can move into commodity, BSE and NSE can move into commodity markets. We too can move into the stock markets. But we have decided to focus on our strength. So we are in the commodity markets as of now. Whereas NSE, BSE, their focus is mainly on the stock market. So although they have a few contracts in the commodity markets, but they are not yet, they have not yet got a significant market share. But in the days to come, that could happen. Yeah. So monopoly, yes. There are, in every country, you can't have multiple numbers of commodity exchanges. Okay. For various reasons, what happens if you do that is that the volumes, that means the number of people who trade, they get bifurcated. And if the people get bifurcated, so basically, let's say there are 5 lakh traders for a particular commodity, and let us assume there are 20 exchanges. Then these 5 lakh traders will get bifurcated into all these different exchanges. So where is the loss in this? The loss is that there's not going to be any price discovery. For price discovery, you need many buyers and many sellers. Now, if you end up having a less number of buyers and sellers on each of the exchanges, just because there are many exchanges, you will end up having a situation where the price is not coming out. See, like I said in my first session, it is not an exchange price. The price is the price which has come because of large numbers of buyers and sellers trading on it. So the price discovery will not happen. So even if we have a multiple commodities, that means a same commodity offered by 2-3 exchanges, you will find that these contracts have got different expiry date. So there are different sets of people who are trading on my exchange, a different set of people trading on another exchange, and so on, depending on which expiry date is suitable to them. Okay, and so that is, but again, we have noticed that again has the same problem. It is bifurcating the number of people. Yeah, so and we are not getting a good price.
If I can interrupt you, sir.
Yes, sir.
Can you throw some light on the lack of interest in currency derivatives or interest rate derivatives? Only equity derivatives are more popular in our country. Whereas if you see NYMEX or other CME or other things, can you just throw some light on that, sir?
I'll tell you one thing. Interest rate derivatives, they are a very complex product. They are a much more complex product. So when you trade in a derivative segment, you have 2 types of traders. One are those who are hedging the risk, and there are those who want to try and make money on the movement of the price. Okay. Now, those who are hedging, they are the ones who have more knowledge about the basic product. Those who are investors, they are just trying to make money on the price movement. So if you compare the level of knowledge, generally you find that those who are hedging have got a superior knowledge because they have a purpose, whereas the others are just waiting to try and. But by the way, both of them are very important for the markets because they are bringing liquidity. The investment community is bringing liquidity to the market, which means that every time a hedger wants to enter the market, there is somebody sitting on the opposite side willing to take the opposite position. However, when you are having a complex product like an interest rate derivative, you will always find that the general public will not enter that market. Okay. The second one is when you have the currency derivatives. Currency derivatives, we were actually and the MCX had an exchange earlier, so many years ago. Then it was converted into a metropolitan exchange, and it is now an independent exchange. So I was associated with that, and in the early days we were doing huge volumes on that exchange, but subsequently, now what has happened is that to make trading easier, now you need a common account with a broking firm. So you can trade in stocks, in commodities, in interest rates, in currencies seamlessly with the same deposit. So I have a common deposit and I have so many different asset classes in which I can put my position. So it's only natural that I will go to an asset class where I think I have a better knowledge base. Yeah. Earlier, what would happen is that we would have a lot of people who would have a deposit for trading in in currency, and they were limited to that currency market. They had the deposits placed there, and they would continue trading in. Now that it has become common, so we have found that people are moving away. So they're moving into some different asset class. Okay, so although the regulator has made it simpler for the trader by ensuring that he can jump from one asset class to another using the same deposits, but what it has actually ended up doing is it has moved the entire trading community to stock markets. Yeah. So we also at the commodity markets too, we too have felt that the problem. Yeah. Okay.
Thank you so much, sir. Thank you so much.
Right.
Hello. Yeah. Good afternoon, sir.
So any more questions?
Yes, sir. Good afternoon, sir.
Good afternoon.
So actually, I have three questions. I'm a student, sir.
Yeah.
So sir, the first one is from yesterday's class, sir. In the benefits section, benefits of hedging, you
Yeah.
told that we have to monitor risks, and at the same time we don't have to focus. We don't have to involve in this much because we have to we can focus on core business activity.
Right.
So how can be done at the same time, sir? Means how frequent we have to monitor the risks?
Okay. See, when I'm talking about focus on the contract, there are two things. One is you're looking at the contract. Who is going to look at the contract and what is happening to the position that you've taken is the Treasury Department. So Treasury Department is watching the movement of the prices of the contract. Okay, they have to take a decision as to whether they want to, which is the best time to square up their position and so on. Okay, but do remember, once you square up your position, then your position becomes unhedged. So that is the part where if the contract is coming to an end, say 3 days ahead, 3 days from now, and I start observing it towards the end of the contract, and I can decide that should I quickly, because if this I can see that there a trend that the prices are moving downwards or the prices are moving upwards. There's a trend, and the contract is about to expire in 3-4 days, so I can quickly square up my position. So I don't need to wait till the last day. Yeah, if I suddenly find there's something happening, I can quickly cut my positions and come out of the market and remain unhedged. So basically, that is the part when I said you have to monitor your positions. The other one is about focusing on your core business. Yeah. So that Treasury guys are looking at your derivative positions, whereas you, when you're trading, when you are running a business, like suppose I'm running a car manufacturing concern or a scooter manufacturing concern, then my focus should be on quality of the vehicle I'm making. I should be looking at the marketing of that vehicle. I should be looking at trying to get a bigger market share, trying to improve the quality of the final product, trying to get more distributors. I'm looking at how to enhance the bottom line of the company. Yeah, rather than spending my time to find where I will get the cheap plastic, where I will get the cheap copper, what is the right time to buy a battery at a lower price. Should I buy now? Should I have bought it 2 months ago? Shall I wait for another 3 weeks to buy it? I should not focus on all that, because the price risk has already been taken care of by the Treasury team. Yeah. So I should be focusing on the core business that I'm in, and my Treasury department will try and make my positions efficient by deciding as to when to square up the positions or whether to remain with the position right up to the end and take delivery of the commodity. Yeah, so that is the point I was trying to tell you.
Okay, so it means that once I have invested, then the Treasury department will look after that.
Absolutely.
Yeah. Okay, sir. So second question is my confusion, sir. Sir, you told about the currency derivatives.
Yes.
Yes, sir. So if it is traded in the commodity market, then what is the money market, sir?
Okay.
In money market, what we do?
So currency derivatives are not traded on the commodity platform. Okay, so there's a separate market for that. It's a currency derivative market. So there are 4 different asset classes. So you have a capital markets as an asset class, debt market as an asset class, currency market as an asset class, and you have a commodity market. So there are 4 distinct different markets. Okay, they are all interrelated, one market having the impact on the other market. Okay, now when you are looking at a money market is a short-term money market. Yeah, money market is basically about borrowing short-term, lending short-term. It is basically instruments which are generally you find with banks and with the Reserve Bank of India. Okay, so for example, when banks have a lot of money with them, because you have deposited money in your bank account, the bank has got, they're flush with cash. Then what do? Because remember, they need to give you an interest on the money that you have parked there. So they themselves invest. Okay, the banks will invest with the Reserve Bank. Okay, so they invest they can overnight money, 15 days money, time deposit money. They can 1 month. So they have this short-term investment of money. That is a money market. Okay, now the derivatives that you have, that those are contracts launched by currency derivative exchange. Okay, they are independent exchanges, just like BSE, NSE, MCX, and so on. However, just want to tell you that BSE has got, just like they're offering you a commodity platform, they are also offering you a currency platform. So you can trade on, and NSE is also doing the same. There's another exchange which was originally set up by MCX, which we have hived it off, called Metropolitan Exchange. They also trade on currencies, but I think that exchange is not doing so well. But the point of the matter is that you have exchanges where you can trade in currency derivatives. Now, when you trade in currency derivatives, this is open to the general public. So you can go and trade on that particular platform. So you can buy, just like you can buy gold futures, or you can buy a potato futures. So on this exchange, you will be buying currency pair. So you say rupee dollar futures or dollar yen futures. So it's always a pair, a currency pair that you're buying. So what are you buying at? What price you're buying? Well, what is the exchange rate today? I'm not sure. Let's assume the exchange rate is 74 rupees rupee dollar, right? Now I can bid to buy on a platform, for currency platform. I'd say I want to buy at 72.50. Yeah, so I'm basically buying at 72.50 exchange rate. When? In January of 2022. It's a derivative. So I'm bidding, I'm buying at that particular, so if it's an options contract, then I'm offering a premium to buy, or if it's a futures contract, so I'm trading at that particular strike price, at that particular price, the exchange rate. So in a derivative, currency derivative, you are buying a currency pair in the future. What is your starting point? Your starting point is, what is today's exchange rate? What is the holding cost? Well, you're looking at between today and the date when the contract comes to an end, you're looking at what could happen in between that period, just like you do in the commodity market. Okay, but the factors in currency markets are much more, and they impact much more quickly, yeah, than they do in the commodity markets.
Okay, thank you so much, sir. I have cleared my doubts, and I must say that this session was brilliant, sir. Thank you so much, sir.
Someone has asked a question: how far have we moved from the NSCL crisis of 13? Sir, I've already forgotten it. I have no idea what about it. Okay, the NSCL crisis of 2013. It was a separate exchange. Yeah, it was exchange which was away. It was different from MCX. It was a sister concern. We had the same promoters, and it was running parallelly. So that exchange, I think mostly is settled, from what I've heard.
Hello, sir.
Yeah, hello.
Sir, wonderful explanation by you, and certain, question and query which I have.
Please.
Should I go forward?
Yes, please.
Sir, most of the time, as we see in equity market, while trading in derivative, there is exact amount of quantification. What exactly will be the contract, depending upon the market-wide limit and open interest, and some point of time, we do make a wise guess through put-call ratio, how to sense whether market is going up or down by assimilating these things. Is there any parallels in commodity?
Yes, very much so. Yeah. in commodity markets as well. In options, we have in the commodity markets we have something called position limits. Okay, in futures we have position limits. In options, the limits are twice what you have in futures contract. Okay, so there is a position limit on options contracts as well. Options derivatives. Yeah, we have. So commodity options. Sorry, we have a position limit. But because our contracts are deliverable contracts, when the contract expires, it converts into a futures contract. And once you convert into a futures contract, you will have to abide by the position limits stated for the futures contract. So you have to abide by that rule. So we do have a position limit as well. Okay, in commodity contracts. What was the other part of the question that you asked? About
one more question was what exactly, I mean, what decide the total number of contract? Is there any relation between the underlying and the, the number of contract which is floated by exchange?
Well, not about the number of contracts, because we have, we'll have contracts which are there'll be one contract expiring next month, another contract expiring the month after that, one more contract expiring subsequent month. Yeah. The only difference would be that, when I'm buying a derivative, I'm trying to price a derivative in the future. Now, I will not be able to, rather it'll be difficult for me to price a commodity March of next year as compared to pricing it for next month. Okay. With the result, you will see higher liquidity, higher volumes being traded in the near month contract. That means the contract which is about to expire. Whereas if you're looking at a contract which is far away in the future, you'll find less number of people willing to trade on that. The reason being, the factors which can influence the price between now and that day in the future, there are many more factors, and it all depends on how what kind of a risk taker you are. If you're willing to take the risk, then you will be happy to trade in a contract which is expiring even 1 year ahead or 2 years ahead. Yeah. Whereas if you don't want to take a risk, then you will be taking your position in the near month contract. In the near month contract, what it does is it has large volumes. That is more number of buyers, more number of sellers, and hence the price discovery is far more efficient in a near month contract. Okay. So that is one advantage of. But when you're saying we have many contracts of this, no, we don't have many contracts for the same day. We will have contracts for different points in time in the future. So you can pick on any contract and trade. In options, of course, if you're talking about options, we have for every contract, we have a number of strike prices. So you can trade at any strike price. So we'll have something like 51 strike prices for gold contract, for example. So you can pick on the gold contract, trade at any of the strike prices that you want. Yeah. So you generally, again, because these contracts are what we call options on futures, and hence you have to look at the futures price, which is determined by buyers and sellers of the futures contract. And whatever the futures price is, you bring it to the nearest 100, and you look at the options contract at that strike price, and you will find the highest volumes there. Okay. And at the other strike prices, you'll find less volume. I hope I can.
Yes, sir. Yes, sir. Thank you, sir.
Yeah.
Okay. So one more question. I mean, often perplex me, and maybe it perplex to so many traders. Some part of time, it is reasonable. We are having ample liquidity, and a lot of, stakeholders are there in form of hedgers, speculator, trader, investor. Serious business, but some part of time certain commodity do get hijacked by the trader only. I mean, the subsequent underlying commodity and parallel to the kind of volume which it witness and the implied volatility it witness, and it gives threat to the risk management system. So, sir, is it price discovery or a particular commodity got hijacked by the speculator and trader?
So we have a very clear limits, position limits are there for that purpose. So nobody can hijack it that way. Yeah, not on a commodity, not on. It might be happening on some other exchange, but not on my exchange. We have very clear position limits on exchanges where there's a whole very strong surveillance department, which is ensuring that there is not much that there are arm's length transactions. So we do a very strong KR. We have a KYC system in place. It is not just done once, it is done on regular intervals to ensure that we don't have a group of people getting together and trading. The other thing is what the regulator has done. The regulator has ensured that if there is something going wrong on one exchange, then that information is shared with all the exchanges. So everybody is well aware of what is happening. In case there is some sort of people getting together and creating some sort of a consortium to try and dupe the trader, common trader. So not happening in the earlier days. Perhaps it did take place, but not anymore. Right now, the exchanges are very well aware of different kinds of issues, and hence the position limits are the tool that we use in addition to this very strong surveillance mechanism, which actually tells us at any given point in time where the trades are coming from, who is putting in the trades. All that detail is being captured. We know when that information is shared with the regulator as well on a day-to-day basis. So the regulator gets information as to who is the largest trader of the day, who is in the top 10 large traders of the day. That information is given, and everybody is aware that if something is going wrong, it comes under the scanner very quickly. Yeah, so nothing to be worried about on this area.
Thank you, sir, welcoming the query and giving a very comprehensive and detailed answer. Very thank you, sir, from bottom of my
Sir, a quick comment, sir, in this discussion, if you permit.
Yes, sir.
This regarding this price discovery.
Yes.
It is a highly chaotic process, and it takes no prisoners.
Sorry, I didn't get you.
It is a highly chaotic process, and a lot of profits and losses are involved. As a trader,
Yep.
When I enter into the market.
Is it commodity markets you're talking about?
Yes, sir. For that matter, any speculative market.
Commodities. Okay.
Any speculative market. I think losses and profits, losses are common, and the price discovery, that is the soul of price discovery market. Yes. Yep. Some of the participants told that there will be a lot of corners and all these things.
Sir, in one of my slides today, I talked about the different types of margining we have. Yeah, we have special margins, additional margins. These margins are imposed based on the surveillance that is being done in the market. So if you find that because of speculation, the prices are going up very high for no reason, that means in the market, the price of a commodity need not have gone up that high, or should not be going up that high, or should not be falling that low, right? So that is being captured. And the minute that is noticed, then additional margins are brought in. Additional margins, what it means is that it drives away the speculators from the market. So if you find a commodity which has got a very high margin, it just shows that the margins are high to discourage speculators.
I think, I'm sorry, sir, I think in the interest of time, I will just mention one, this Hunt Brothers Silver Corner.
Okay.
I just leave it to Professor Narayan Reddy, sir. I think, thank you very much, sir. Thank you.
Okay, thank you. Thanks.
Thank you very much, Srikanth, sir. Now,
thank you.
Now I hand over to Gaya to proceed the quality.
Can't hear you, madam.
Once you stop learning, you start dying. So a very warm good evening to all. Myself, K. Gaya, Assistant Professor, Sri Vidyaniketan Institute of Management. On behalf of the Sri Vidyaniketan Institute of Management, we are delighted to offer a gracious welcome to all of you for valedictory. It's an opportunity for me to welcome today's chief guest for the valedictory session, Dr. Shikta Singh, Associate Professor, KIIT University, Bhubaneswar, and Srikanth Kaudinya, Assistant Vice President, MCX, Mumbai. Thank you, ma'am and sir, for being with us today in spite of your busy schedule. Now I take this opportunity to thank our beloved director, Professor P. Narayan Reddy Garu, for being a good mentor and guiding us on the right path. Thank you, sir, for the consistent encouragement and support. Thank you, sir, for being with us and making this workshop successful, sir. Now I request Director of SWIM, Professor P. Narayan Reddy Garu, to give closing remarks.
Very good evening. Now we are nearly 4 p.m. I am very, very happy to be offer my closing remarks on behalf of Sri Vidyaniketan Institute of Management, Tirupati. I am very, very happy and delighted to see Dr. Shikta Singh and also Srikant Kaundinya. And to my surprise, Dr. Dhananjay is also joined for this particular session. The most welcome, Dhananjay ji.
Thank you so much, sir. I'm humbled by your remarks.
So I'm happy to recognize that you are there as one of the important persons. I am sure that with your presence, our session would have been much more active and live with your questions and observations. And I am extremely happy that my colleagues, Professor Gurunatha Naidu, Professor Sudarshan Murthy, have initiated this 1 week program on behavioral finances and also leading to create awareness about the investment opportunities for the people. And all these days, the resource persons like Dr. Shikta Singh and Srikant Kaundinya, and they have shared their expertise with our participants. And this session, all these sessions must have made the tremendous impact on the participants. I, being a layman on the behavioral finances, and my understanding of the stock markets is virtually zero. When I try to interact with the people and how they invest their minimum resources, how systematically they plan, how to choose the sources to invest their hard-earned funds and money. And some people always say that very frequently on a lighter side. So yesterday, air crash was there at so-and-so place, therefore the stock market is like this. And it rained very heavily in Orissa, therefore the stock markets are like this. And like this, if the people are giving interesting examples and the investment opportunities, and a few organizations, like for example, Facebook lost $8 billion just because it could not perform for a couple of minutes and hours. So all these things are important aspects to observe, and how these things influence the investor's psychological state while choosing the investment opportunities. And everyone wanted to earn something out of the hard-earned money, but very few will gain, many may lose. And this was the best example was there in the long back in the early 90s. You must have seen that thousands and lakhs of people promoted enterprises, but many could not survive, and few survived, and many could become the millionaires by investing in the stocks. And all these things are very interestingly influence the psychological state of the person. And again, so in the given uncertain environment, we are all trying to create some certainty within the uncertain environment and try to build some models. And these models are helping the investors. And our entire exercise is to bring more and more number of people, those hitherto are outside the market system. If we bring at least 5 to 7% of non-investors into the stock market scope, I am sure that the present stock markets and will be much more vibrant compared to the existing system. Because India being 140 crore population, and I'm sure that more than 8 crore people are virtually having capacities to invest, but so much people are not investing, and many broking companies are performing on behalf of one or two investors. Actually, I have seen it. So therefore, it is essential for all of us to create better environment, better awareness, and also some type of clues to the young and prospective investors. I'm sure that stock markets will gain momentum to move forward from the existing level to the next level. In this process, if we able to create the environment, I'm sure that many more entrepreneurs also will come forward to start the enterprises, because they get an opportunity to get funding. That's very important. The important reason why many could not become entrepreneurs, though they have an excellent idea, is because the funds crunch. So if the stock markets are going to help the prospective entrepreneurs, where they are able to generate more and more investments from the investors, and the entrepreneurs will get better funding. That better funding will help the more and more number of entrepreneurs. It works as a motivation to them. And I am sure that this particular 5-day program certainly has created strong awareness. And I'm sure that the participants are going with a strong and lot of takeaways. And I congratulate my colleagues, Dr. Gurunatha Naidu, Dr. Sudarshan Murthy, for having initiated such a nice program and creating a lot of awareness among the participants in the society. And also congratulate them, and also thank my colleagues who have directly and indirectly extended their full support to run this program very successfully, Dr. Rani and Dr. Gaya and others. And finally, I sincerely thank the resource persons. In spite of their busy schedules, there is a lot of enthusiasm among the resource persons that they're very much interested to share their knowledge with the people. Thank you very much, sir, for Dr. Shikha Singh and also Srikanth Kaundinya for having joined us. And I request Gaya and others to continue the program. Thank you very much.
Thank you, sir. Thank you for your valuable words. So it is great pleasure to invite Dr. Shikha Singh, Associate Professor, KIIT University, Bhubaneswar, for enlightening the participants on behavioral finance. And it was a great session with loads of information. Now I request Dr. Shikha Singh to speak few words.
Thank you so much indeed. Thank you, Sri Vidyaniketan Institute of Management, for coming up with such a well thought of program for the long 5 years, 5 days of this workshop. I'm in fact grateful to those organizers as well as the chairman of Sri Vidyaniketan Institute for inviting me. And I hope during our discussion for the past 2 days, the participants have learned, or to what extent have they absorbed into it, I leave up to them. As we know that today, at the very instance, our RBI governor, Mr. Shaktikant Das, he has announced with the approaches pertaining to the monetary policy. And he has stated about a monetary policy pause, right? That means there is not going to be any change as far as the rates are concerned. Repos are again trying to be maintained at 4%. So creating this amount of status quo bias, that means again, which is a contemplation of the behavioral dimension into it, because the policy stance continues to be accommodative in nature. And I think this is for the 8th consecutive time that the Monetary Policy Committee has maintained this status quo rate. So in this sense, when you think that the RBI continues to be supportive of the driving force of growth, thereby maintaining, which had stated that 7.3% in this current rate as far as the real GDP is concerned. So the economy is trying to get through its waning interest rate, keeping the liquidity conditions comfortable for all the stakeholders, be it with the FIIs, that is your institutional lenders, be it at the individual lenders. So what I feel that this unchanged policy rates, which is an accommodative stance, it will keep up the optimism of the market participants. That means it can create an positive optimism bias into calling for more amount of investment into the market. So if more investment flood in, it can have a positive impact into this Sensex, which can create a positive drive force in order to spike up the rates, and so as our GDP factors. So lowering the inflation projection also, which has taken up from 5.7% to 5.3% for this financial year 22, it would be a positive factor, which can signal to the hardest interest rates unlikely in the near term. So in order to achieve the GDP growth, which has remained stagnant and it can for this time period, which has been now casted to be 9.5% with an upward revision maybe by the fiscal year 2022, but that can gradually call for a recovery, thereby spiking up the aggregate demand. And if I see that if our 4 pillars of GDP drivers, which we say that your consumption, investment, the government spending policies, and so as our trade balance, if they are into proper horizons, then the economy, the momentum effect of the economy will keep on rising. So that is what I predominantly feel, that the infusion of finance with economics, thereby the outliers of psychology having its impact into it, can build upon a huge arenas of research, thereby calling up the factors into it. And thank you again. Thank you so much, Dr. Sudarshana. Thank you so much for inviting me and giving me this wonderful platform. Thank you so much, Shrikant sir. I missed your session, even if I wanted to. Right now also, we are going on with the PhD interview process. I'm sorry I am unable to continue further, but I'm deeply, I am privileged and I'm humbled for this platform. Thank you so much.
Thank you, ma'am. Thank you so much for gracing this session. Once again, thank you. So it is my immense pleasure to invite Shrikant Kaudinya, Assistant Vice President, MCX Mumbai, for sharing your deep knowledge about commodity derivatives with us. Your words were full of enthusiasm and valuable knowledge, sir. Thank you, sir. Now I request Shrikant Kaudinya to share few words.
So all I can say is that it's a new area which is really, in India, it is really taking off in a big way. I'll especially ask the students not to miss out on it. As far as trading that takes place in commodity markets, we have noticed that a trading which was happening in Hong Kong, Singapore in the past, someone did a research and they found that 40% of traders are of Indian origin. And that's again, same with Dubai. In Dubai, it's probably more than 50-60% of the people who trade on exchanges in the Middle East are there of Indian origin. So it is, the government has taken the right step, I think, that they have set up an exchange in the gift city in Ahmedabad, where you have started launching of contracts, which is now open to the world. See, I had said in the very first session that India is a price setter for commodity. Sorry, we are a price taker for a commodity. We are not a price setter. Yeah, but one of the reasons is because our economy is such that we can't open it and allow people from the rest of the world to come in. We can't expect, or we should not allow people to come into the Indian economy and start trading here and take away the money and bring in the money at will, because it will disrupt the exchange rates significantly. But that we can wait for some time in the future. So at the moment, following the model that was which was there, the Hong Kong model, where Hong Kong got absorbed into China, and it was one country, two economies. I think we can think in those terms and look at the Gift City model, where we are having exchanges which will allow for international players to come and trade in dollar terms on the Indian shores in almost like an SEZ environment in Gift City, Gandhinagar in Gujarat. And so that is a new thing. So we are seeing lots of developments happening, new kinds of contracts being launched. And I'm sure that as we go ahead, we will be really moving up from the exchange point of view, from the 6th largest exchange in volume terms to maybe the 2nd or 3rd in a very, very short time. The other interesting fact that was brought in by Dr. Shikta Singh was that interest rates have not been changed again. Yeah. The point is how much lower can they bring the interest rates? The interest rates are quite low at the moment, and no country wants to upset the apple cart. And, and everybody keeps saying that they might do something to interest rates, and basically about increasing interest rates. It won't happen so fast. It's going to probably happen next year, maybe end of next year. But that's my vision. That's my view. Okay, and I hope interest rates don't change. But do remember my first session, interest rates change, and they do have an impact on exchange rates and have an impact in turn on commodity prices in India. Yeah. So good to know that today interest rates have not changed. Otherwise, they would have brought in some sort of disruption here. But I hope that all of you enjoyed my sessions. I quite enjoyed giving my views, and I hope that you've learned from my sessions a bit. And I quite enjoyed the question answer sessions today. And thank you very much. I quite enjoy us being associated with your institute every year. And I hope that you will invite me again in the years to come. Thank you very much.
Thank you, sir. Thank you
Definitely,
for your
sir.
valuable information, sir. Thank you, sir, for gracing this session and making it successful. And now I request Professor D. Sudarshan Murthy, coordinator, to speak few words.
The renowned personalities, today's valedictory guests, Dr. Shikta Singh Garu and Srikanth Kaundinya Garu. One is expert in behavioral finance. Another one is a professionalist with regarding the commodity derivatives. My dear colleague friends, Honorable Director, senior colleague in the department, dear participants, very good evening to you all. This is Professor D. Sudarshan Murthy. At the outset, I have done my FDP program in Atal. There, I came to know that one great delivered lecture, when great personality is there to deliver behavioral finance. At that time, I was much impressed with her lecture. Dr. Shikta Madam was a good resource person that I came to know previous days, in those days. With her effective delivery of lecture, I was impressed. At that time, I came to know that why can't we bring her to the platform of my institute? At the same time, Srikanth Kaundinya sir, he is also a great person. He is a professionalist in the field of commodity derivatives. So he is behind the curtain, no doubt, at any time, at any cost. If the institute to make a call, immediately Srikanth sir will respond and give his guest lecture through the webinars. Earlier, he has done sponsored. We have done some FDPs in the institute itself. Srikanth Kaundinya sir sponsored also. So that much of relations maintained this institute with Srikanth sir. So these personalities, how to bring to the platform. Behavior is nothing but a psychology. After listening the class of Shikta Madam, each and every person must have to know about the behavioral finance. It is mandatory on part of the every person. At the same time, the investor should have the knowledge with regarding the behavioral finance. And market related SOR is also there. But how to get her to the platform? Immediately, I thought that through WhatsApp, I sent a message stating that, Madam, I am humbly requesting you to deliver guest lecture to my beloved students. For that purpose, I am sending this message. Kindly accept my proposal. Immediately, she has given a response. I asked her mail ID through mail. I approached her. Since then, she has been remembering me when it is, then by what time and what topics that I have to deliver my lecture. Immediately I said, Madam, from fundamentals to some theories, whatever the topic that you decide, I can post into the brochure. You tell me, Madam. Immediately, yes. One more thing, the title also decided by Shikta Singh herself. Next, after that, I approached with Srikanth Kaundinya sir because he is in-house of Sri Vidyaniketan Institute. So with that lenience, I brought to the notice of Srikanth Kaundinya sir also. Both of them accepted. I became very happy. The same, I approached to my senior professor in the department, Professor N. Gurunatha Naidu. He also accepted. Since then, myself and Gurunatha Naidu sir started groundwork. The result is this 5-day workshop, a good platform with the two prominent personalities. Effectively, they delivered. One more thing, Sri Vidyaniketan Institute of Management has not paid a single pie to the speakers in form of remuneration or honorarium, whatever it may be. Without that, also, that two persons maximum, they covered the topics from basic to in advanced theories, and each and everything, every day, they highlighted their effective delivery. So this platform, I think, many of the participants utilized, and some of them, they learned the behavioral finance as well as the commodity derivatives, investor perspective also. So I hope that next is I may not be in a position to succeed it. If this workshop has been succeeded, behind the curtain, the two personalities are there. They are Dr. Shikta Singh and Srikanth Kaundinya garu. Sir, on behalf of the institute, I express my sincere thanks to you. Myself also, sincere thanks to you, and Madam also.
Thank you.
Next, I am praying to Lord Venkateswara, give your invaluable blessings to these two persons, especially Shikta Singh Madam and Srikanth Kaundinya sir. That is only I am praying to Lord Balaji to give invaluable blessings to both of you, sir and Madam. At last, I ever grateful to my colleagues, co-coordinators. They have helped me a lot, especially Dr. K. Balaji, Dr. K. Gaya, and Dr. C. Ronnie. ever grateful to Institute because this kind of ample opportunity provided. So thanking you one and all.
Thank you very much.
So thank you, sir.
Primary sources as well as secondary sources.
Thank you, sir. Now I request Professor N. Gurnath Naidu Garu, coordinator, to share few words.
Thank you, Gaya madam. I think end of the day, the last few minutes, we are all connected together to conclude the program. Dhanam Moolam Idam Jagat. The whole program, it is being connected with the derivatives and behavioral finance. At the present situation, scenario, COVID-19, we are all crushed, suppressed, suffocated. We all know that. When we have money, our behavior is different. When we have very less money, our behavior is different. As rightly said by our friend, I can call Srikant Kaundinya sir as a member of Sri Vidyaniketan family now. That's how I feel. He is our brother. Very nicely said. 40 to 50% of the investors, particularly in Singapore and some other exchanges, Indians, they are participants. Indians are always follow the path called dharmic path. They are very conservative. They will always think for the next generations. They have a fear of sin. So that's the reason why even foreigners, they come forward to invest money in our business activities. Personal finance is more personal than its finance. The reason is hard-earned money when they are going to invest either in derivatives market or in stock exchanges. People will always see what sort of ROI I'm going to get, what sort of safety I'm having. These 2 days, Dr. Shikta Singh and Srikant Kaundinya sir, they very well handled the session for almost 5 days, all the 5 days. A lot of insights you have shared, sir. Really, all the participants, they got benefited. 5,000 years back, Bhagavad Gita, it was pronounced by Lord Krishna in Kurukshetra. I still remember. You both, 2 persons like Lord Krishna and Arjuna, you handled the whole session. Sir, we remember you throughout. Both of you are very nice, very kind, and very soft and very, very cooperative. We, on behalf of Vidyaniketan Institute of Management, Sri Vidyaniketan family, once again, I extend my heartfelt thanks to both of you. When we discussed with our director, Professor Narayan Reddy Garu, and when we shared with our team, they felt very happy about this concept and everything went well. An investor's worst enemy is not the stock market, but his own emotions. We know stock markets and derivative markets, people have earned money, they have lost money also. But if they fail to control their emotions, if they don't take timely decisions, they definitely experience in the form of either losing or gaining. I'm extremely happy as a coordinator to share my views. When my friend approached and we discussed it together, myself and Professor Sudarshan Murthy, we thought that this is an appropriate topic at this right time. Hence, we have chosen, we have extended nice cooperation. Participants, really, you have, with a lot of patience, the first day, due to technical glitches, few things went wrong. In spite of that, you are kind enough to connect with us for all these 5 days. So I extend my thanks to all the participants, resource persons, and the entire committee members, Dr. C. Rani and Gaya Madam and Dr. Balaji, and the technical wing who is behind the scene, and my friend, Professor Sudarshan Murthy, who made this program a grand success. Once again, thank you very much, sir. Pray Lord to bless you with good health, peace of mind, and whatever you are intended to achieve, I pray, Lord, that for both Dr. Shikta Singh and my friend Kaundinya sir, to get all with the blessings of God. Thank you very much, sir. May God bless you. Thank you. Over to Rani Madam.
Thank you, sir. Thank you for your humble words. Gratitude is the fairest blossom which springs from the soul. It's time to show our gratitude to the people for supporting us to make this workshop successful. Now I request Dr. C. Rani to propose vote of thanks.
Thank you, Gail. I take this time to propose vote of thanks. Vote of thanks to everyone who has helped us in making this workshop successful. First of all, I would like to thank our Honorable Chairman, Headmaster Dr. Manju Mohan Babdari, and CEO Vishnu Manchuhar, providing an excellent platform and the opportunity to present events of this kind. I extend my thanks to our beloved director, Professor P. Narayan Reddy Garu, who is instrumental in conducting several events for the benefit of students and faculty. Thank you very much, sir. Dr. Shikta Singh and Shrikant Kaundinya on behalf of Sri Vidyaniketan Institute of Management, and from the bottom of my heart for taking time from your busy schedule to be the resource person at your workshop. Thank you, madam, and thank you very much, sir. I also extend my thanks to all in-house faculty members for their support. Special thanks to Professor D. Sudarshan Murthy and Professor N. Gurunath Naidu sir for arranging this workshop. Last but not least, I appreciate all the students who have initiated in participating and made this event a bit successful. Thank you very much. Thank you very much to everyone. Over to you for valedictorian.
Thank you, ma'am. Thank you, one and all, and have a wonderful evening. Thank you.
Thank you, Shrikant Kaundinya. Thank you, Shikta Singh. Congratulations to everybody.
Ma'am, share the feedback link, ma'am.
We will send through the WhatsApp.
No. Feedback is already posted.
Ma'am, what about certificate, ma'am? Feedback is not showing in the chat box, ma'am. Kindly share this feedback.
Madam, good evening, madam. Are you sending that feedback link through chat or WhatsApp? Hello.
Ma'am, send me the feedback link, today feedback link, ma'am.
No, madam. Madam, are you sending that feedback link in the chat box or WhatsApp group?
Sir, please wait, sir. We are posting in chat box, sir.
Okay, sir. Wait. Okay,
Yes,
thank you.
Yes.
You cannot take once.
Participants, please check into the chat box. So the participant, please check into the chat box. You can find the feedback link.
Ma'am, chat box is not visible, ma'am. Feedback link is not visible.
Participant, please check into the chat box. You can find the feedback link. We'll open the same for 5 minutes. Please, you can do that.
Madam,
Ma'am, chat box
feedback link is not attached, madam. In chat box, feedback link is not attached. Not showing.
Ma'am, feedback link is not there in chat box, ma'am.
One second.
Sir, chat box. Not host.
Now you can see it, right?
Now
Yes,
visible.
ma'am.
Now visible.
Yes, yes. Thank you very much. Thank you very much.
Yes,
for the
ma'am,
feedback.
we can.
కనిపించిందంటనా అమ్మా
నువ్వొస్తానంటే